indeed sticky. Now, one of the things that we can also demonstrate is that changes in the short run, changes in nominal prices, or the nominal exchange rate, will affect the prices of imports and exports. Whoops. So here's one way of thinking about that. I've gone back and picked out that basket of goods that we had in the U.S., right? They're all $100. That's what it cost us to produce it. And here's the some exchange rates, 100 yen to the dollar, 110, and 120. Notice that the dollar is appreciating as we move from 100 to 110 to 120. Now we want to ask ourselves, what happens to the price of those American goods, which did not change in dollar terms, but what happened to the price in Japan, in yen terms? And we can see that the price goes up. It goes from 10,000 yen to 11,000 yen to 12,000 yen as the exchange rate increases or appreciates for the U.S. dollar. Notice the U.S. price did not change. So what happens? As American-made goods become increasingly expensive in Japan, the Japanese are going to buy fewer of them. Right? Demand curves are downward sloping. As the price rises, the quantity demanded is going to fall as we move back up along a demand curve. So when we have dollar appreciation in this example, the yen price of U.S. exports goes up, the Japanese buy fewer of those American-made products, and exports just went down. So exports decline. Now let's turn it around and see what happens in the U.S. from Japanese goods. So here we've got our yen price of 10,000 yen each. Same exchange rate, same dollar appreciation. But this dollar appreciation leads to a decline in the U.S. price of Japanese goods. In the beginning, we only got 100 yen for each dollar. So we could buy one 10,000 yen product. But once the yen goes, or the yen depreciates, the dollar appreciates to 110, now we've got 11,000 yen. So we could buy that one good, we still got 100 yen left over to buy other Japanese goods with. So as the yen price, U.S. price falls, Americans will buy more of them, coming down on a demand curve, and U.S. imports from Japan will increase. So notice then that dollar appreciation reduces exports and increases imports. Currency appreciation, exports decline, imports increase, net exports decline. So this will give us one hint then as to how changes in the exchange rate affect the domestic economy. How changes in the exchange rate affect the domestic economy. So we need in our model to really think about exchange rate's going to be changing. What happens to net exports? What happens to the IS curve and the aggregate demand curve? Okay, so with that in mind, let's think now a little bit about how exchange rate should be determined in the long run. So remember, the long run simply means that we have equilibrium. So in the long run, what we should see is the real exchange rate should equal 1. That is, the prices of similar baskets of goods should have the same price in both countries. If we don't, arbitrage should drive us back and forth so that we actually get to the same price. This arbitrage notion is something that's referred to in international trade as purchasing power parity. Our purchasing power of our currency should be equal in both countries. Purchasing power parity, or abbreviated PPP. Now, what purchasing power parity says is it's the nominal interest rate that will adjust to bring this about. The nominal interest rate is what's going to move in the long run. Now, purchasing power parity itself is nothing more than an application of what is known as the law of one price. Right? So the law of one price, in a general application, would say if we have two locations selling an identical good, two countries selling an identical good, and there are no barriers to trade or costs to trade, that is, no transportation costs, no differentials in terms of taxes or other types of legal barriers, then the price of those goods should be the same in both markets. Okay? So this works with international trade. It works in lots of other areas as well. For those of you who drive motor vehicles, you may have noticed that when you needed gas, you come up to an intersection that might have 2 or 3 or 4 gasoline stations. And one of the things that you'll notice is, in general, the prices of those items, gasoline, a gallon of gasoline, if not identical, is generally within a penny or two of all the other stations on that corner. Because if the prices get too far out of whack, what happens? People avoid the expensive station and go to the less expensive station. Right? And so you end up with a similar price in that marketplace. As long as, again, we view the two products as substitutes for each other and there are no barriers to the transaction, then we should see similar prices. Again, in exchange rates, it's the nominal exchange rate that adjusts to bring this about. So let's think what this means. So here's our equation for the real exchange rate. Now, when purchasing power parity holds, the real exchange rate will equal 1. So this will now equal 1. We can forget about this part. Let's solve for the domestic price level. So what that gives us then is the domestic price level equals the foreign price level divided by the nominal exchange rate. So all we've done is taken the dollar price, the yen price, and the exchange rate. We've converted the yen price into dollar terms. So two baskets of identical goods, whatever the price is in the U.S., should equal the dollar price in Japan, or the dollar value in Japan. Right? So that's what purchasing power parity tells us, that the nominal exchange rate will adjust in a way that the prices will be the same in a common currency. Oops. Now, another thing that we can... Did I skip this? Yeah, I did. Okay, so if that is true, notice then that the purchasing power of the domestic currency is the same as the purchasing power of the foreign currency. Purchasing power parity. Similar goods have similar prices in terms of the same currency. Now, there are a couple of other things that we can do with our real exchange rate equation. So we can start there. Now let's do it in percentage change terms. So the percentage change of our real exchange rate is approximately equal to the percentage change of the nominal rate plus the percentage change of domestic prices minus the percentage change of foreign prices. Well, the percentage change of prices is simply inflation. So what we see then is that a change in the real exchange rate approximates the change in the nominal exchange rate and the difference in inflation. Here, we can take this particular equation and solve for the percentage change in the nominal rate. So a nominal appreciation will occur only if there is an appreciation in the real exchange rate or a change in the relative inflation rate, higher relative foreign inflation. And we can go one step further. Let's now suppose that we have purchasing power parity holding. Or, if it doesn't, let's assume that the real exchange rate doesn't change. Then in the long run, the nominal exchange rate change will reflect inflation differentials. And this suggests that we have relative purchasing power parity. So let's back up to that chart that we saw earlier that had the Japanese yen real and nominal exchange rates. So notice that those two are drifting further and further apart. So the drift between those two actually reflects, notice we've got changes in the real rate and we've got changes in the nominal rate. So the difference between those two is going to reflect different inflation rates. So since this is a depreciation of the dollar, what it suggests is that inflation in the United States has been higher on average than inflation in Japan over the last 25 years, 30 years, which indeed has been the case. Inflation in the United States over that period of time is probably, at least from 1985, probably been somewhere in the neighborhood of 3 or 3.5%, and in Japan it's probably been 1 or 1.5%. So we should expect that the U.S. dollar would depreciate over time, as it has. Now, another way of looking at purchasing power parity is through something known as the Big Mac Index. This is something that The Economist magazine has done for, I think, annually for more than 30 years now. They go around to all the countries that have McDonald's restaurants, and they price in local currency terms what a Big Mac costs. Now, of course, some countries that have McDonald's don't have Big Macs, but most of them do. And, of course, a Big Mac is a Big Mac is a Big Mac, right? They're pretty identical, regardless of where you are in the world. So we've got an identical product priced in local currency terms that we can also look at in terms of exchange rates. So if purchasing power parity were to hold, we should be able to buy a Big Mac at the same price anywhere in the world. But when we look at the data, that is clearly not the case. In some places, Big Macs are much cheaper than purchasing power parity would suggest. In other places, they're much more expensive than purchasing power parity suggests. So let's look at some of the data and see what we can see here. So we've got a list of countries here on the far left. The next column is our local currency terms for a Big Mac price. Okay? So in Norway, this suggests that a Big Mac costs 46 krona. I think krona is Norwegian currency. In Switzerland, it's 6.5 Swiss francs. In Canada, it's $5.53 Canadian dollars. Right? So it says here that in the U.S., it's $4.56. I have no idea whether that's true or not. You'd have to go to McDonald's to find out. Okay, so we've got a lot of different currencies. Well, okay, that doesn't help us much. So way over here, we have the actual exchange rate. So the actual exchange rate for the Norwegian krona was 6.13. So if we took the foreign price and divided that by the exchange rate, that is column, let's call this column 1, 2, 3, 4. So this would be column 1 divided by column 4. Right? So this is going to equal the dollar price, the actual dollar price, which is column 2. And when we do that, we see that in Norway, in dollar terms, a Big Mac costs $7.51. And in Switzerland, it costs $6.42. And way down here in China, it costs $2.61. So one of the things that we see is the dollar prices are all over the place. And in fact, there are very few that are close to the U.S. price of $4.56. Right? Australia being the closest at 5.04. And in the dollar price of Australia at 4.62 and Turkey at 4.35. Okay? So we're all over the place. So what does that tell us then? So what column 3 shows, what predicted means, is this is what the purchasing power parity would suggest. That is, it tells us what the nominal exchange rate should be if purchasing power parity existed. So what does that mean? What does it mean if we look at Norway, that the actual exchange rate is 6.13, but the purchasing power parity is $10.10, or the exchange rate is 10.10? Or what does it mean in the case of China, that the actual exchange rate was 6.13, but the predicted exchange rate was 3.15? That's what we want to think about. So one of the things that this suggests is that if the predicted is less than the actual, the currency is undervalued. That means the real exchange rate is low. When your real exchange rate is low, less than 1, then what we should see is a movement back towards purchasing power parity, that exchange rate has to appreciate. So if China, from China's perspective, if the renminbi exchange rate goes from 6.13 renminbi to the dollar to 3.51 renminbi to the dollar has depreciated and the renminbi has appreciated. So what we mean then is current exchange rate, we're under our purchasing power parity value. Notice just the opposite is the case for Norway. In Norway's case, they're only giving up 6.13 krona to the dollar now. They should be giving up 110.10, which means that the krona should depreciate. They should be giving up more, and the dollar should appreciate. So this information then can give us, to the extent that the Big Mac Index doesn't violate everything, all of our other good assumptions, this should give us just a general view of how we could assess whether a currency was undervalued or overvalued. Now, it turns out that this is not really a good example of trying to figure out purchasing power parity. Because while a Big Mac may be very similar from one country to the next, as far as I know, nobody exports or imports Big Macs. The arbitrage opportunities are not very good, right? It's not like you can go down to McDonald's in Berkeley and buy 14 million Big Macs and ship them over to Norway and actually get the equivalent of $7.51. My guess is Big Macs wouldn't be very good by the time they got to Norway, right? So this is not a good example, but you could do this similar types of things with traded goods and services across countries, and you would see something that was very similar to this. Now, with that in mind, a couple of things about purchasing power parity. One is, it seems to work in the long run. So when we're talking about long periods of time, we can assume that on average, the currency is near its purchasing power parity basis. But it breaks down quite significantly in the short run. And there are many reasons for that, of which, one, most countries produce a wide variety of goods and services that are not viewed as close substitutes one for the other. If you have items that are not close substitutes one for the other, now the arbitrage opportunities begin to break down. Second, many countries produce goods and services that are not traded internationally. In fact, most countries produce goods that are not traded internationally. And purchasing power parity has to do with traded goods and services. But we're actually using GDP deflators in many cases, which is the price level for all goods and services. So that difference is going to cause problems. And of course, we know that there are transportation costs and other barriers to trade. So for all of those reasons, we might see that purchasing power parity is not likely to be particularly strong in the short run. But let's talk then about exchange rates in the short run. So in the short run, nominal exchange rates are generally determined under one of two types of systems or regimes. We have a flexible, or sometimes called a floating exchange rate system, where demand and supply in the foreign exchange market determines the equilibrium nominal rate. We also have fixed exchange rate systems, in which there's still a foreign exchange market that determines the nominal exchange rate, but then we also have government intervention on top of that private sector determination of the exchange rate to fix it at some particular level. And we'll talk a lot more about fixed exchange rates on Thursday. But fixed exchange rates require the central bank to intervene in the foreign exchange markets. With flexible exchange rate systems, currencies will appreciate or depreciate depending upon whether the demand for domestic currency-denominated assets changes or the supply of domestic currency-denominated assets. So notice I did not say demand for the currency or supply of the currency. What the demand's for is not the currency per se, but the currency in order to buy assets on the other side. Remember, $5 trillion worth of foreign exchange transactions per day. They're not moving that money around just to hold some other kinds of money. That money is being exchanged in order to make financial investments of one sort or another. So that's why we say currency-denominated assets is what we're after, not just the currency. Now, one of the simplifying assumptions that we're going to make is that the supply of currency, domestic currency-denominated assets is fixed. And it's independent of the nominal and the real exchange rate. The reason that we're making this assumption is that for most countries, the supply of domestic currency-denominated assets is incredibly large. So it's estimated for the United States that it's in the hundreds of trillions of dollars. Right? So think about all the assets that are in the United States that are priced in terms of dollars. Right? All the stocks, all the bonds, all financial instruments, all the real estate, all the buildings, right? All the non-corporate businesses, all the mineral deposits, all the crops. Everything that's in the United States is priced generally in dollar terms. So it's literally in the hundreds and hundreds and hundreds of trillion dollars. Whatever happens in the foreign exchange market is just not going to be big enough to affect those types of numbers. So we're simply going to assume that the supply of domestic currency-denominated assets is fixed. Whoops. So we've got our exchange rate on the vertical axis and the quantity of dollar-denominated assets on the vertical axis. I just said that backwards, didn't I? Okay, so I was looking at it sideways. So the exchange rate on the vertical axis and the quantity of dollar-denominated assets on the horizontal axis, and our supply curve of dollar-denominated assets will be vertical. Okay? So changes in the real nominal exchange rate have no effect on the supply of dollar-denominated assets. So now we can focus on the demand side. And basically, what we want to think about is, I got a bunch of money. I can invest it domestically or I can invest it in a foreign country. How do I make that determination? Well, the first thing I want to know is, what's my rate of return domestically versus my rate of return in a foreign country? And because I need to exchange my domestic currency into a foreign currency to make a foreign investment, I also know that at the end of the time,